Next, we're going to talk about page 4, which is the statement of income. Once again, you'll notice it is separated between two columns. Column 1 is the current year operating results. Column 2 is the prior year, so you've got the comparative to the prior year financial statement. The first section is underwriting income, and that deals with what were the premium income numbers versus the losses paid or incurred, and loss adjustment expenses paid and incurred, and the other operating expense. So you're going to be looking at the revenue, the earned income, minus the losses incurred, minus loss adjustment expenses incurred, minus other operating expenses incurred, and that's going to give you the underwriting gain or loss. The next section we're going to talk about on the statement of income is investment income. This is the earned income from the entire investment portfolio for the property casualty insurance company itself. What you need to keep in mind here is that the property casualty insurance company bills and earns or collects its premium in advance when the policy is written. The next section we're going to talk about in the statement of income is the investment income. The first component of investment income is actually the earned income, the realized earned income from the investment portfolio for the property casualty insurance company. One thing I would like to bring up is that the property casualty insurance company has billed and collected either the entire policy term or a portion of the policy term up front. No claims have been paid, no acquisition costs have been recognized. The company has simply collected those premium dollars. The next section we're going to talk about under the statement of income is the other income section. And that is primarily made up of items that do not fit either as premium income or investment income. You've got the finance and service charges to policyholders that are included in other income. And that is simply if the company is making a charge to a policyholder for an installment bill, whether it's $2 or $3 per bill, that gets recognized in finance and service charges. That dollar amount is not subject to risk through loss on the policy, and therefore it is included directly into other income. Next, we're going to talk about the last section of the statement of income, and that happens to be the capital and surplus account. And this is, relatively speaking, one of the more important sections of the financial statement because it's going to give you information about the activity that results in a change to the surplus for the company during that reporting period. As I mentioned a little bit earlier in the statement of income, that generates the operating income or loss net of taxes. That's the first thing that's added to the prior period's surplus, is the net operating income or loss from the statement of income. Next, you're going to see a change in unrealized gains or losses. If there are changes in the market value of the securities held by the company, it's going to be reflected here in this capital and surplus account as a change. You also will recognize any change in the net deferred tax asset will appear. So if you've got an increase in assets, it's going to be reflected here in this capital and surplus account. In addition to that, you've got the change in non-admitted assets. If you recall back when we were talking about page 2, the asset section, you've got a column in there for non-admitted assets. This measures the change in those non-admitted assets from one period to the next in terms of financial reporting. We also have change in surplus notes. In statutory accounting, the property casualty company can actually issue a surplus note as if it were debt, mark that capital on its financial statement, and it is counted as a surplus note, not as a payable out there in the future.